we're starting to see a little bit of more red creep into the S&P, as well as a bit of a cool down in terms of investor sentiment moving out of extreme greed. And as we've highlighted before, earnings season does bring that volatility that can shake the market. And under the spotlight today is SoFi that reported on Tuesday. But actually the reason we want to discuss this company in detail is because they are down more than 8% and they've had a fairly strong set of earnings. So 3 things we're going to uncover. Why is it down? How strong in fact were the earnings? And third, give you our own valuation model, what is our expected price, and Wall Street, where they see this in the shorter term. Now, over the last year, massive performance. They're still up 183%. Year to date, still phenomenal, up 34%. But they're on a little bit of a cool down away from their 52-week high of $25. And we get just the 1 buy rating as of today from Seeking Alpha. They do, however, trade at a high forward valuation at the 80 mark. Question is that justifiable? Now, the main reason why we got this drop today, which investors weren't expecting at all, is that in fact they've announced they're raising $1.5 billion by selling new shares, and they're planning to effectively use this money for working capital as well as other business opportunities. Not something they've actually discussed in depth, so investors getting a little bit worried about the share dilution, and ultimately more shares on the market reduces the value of existing shares. But we do have to bring investors and prospective investors back down to earth. This is an incredibly strong company which did perform a double beat, outperformed on EPS, outperformed on revenue, and if we just look at that quarter, it was absolutely phenomenal. Their revenue itself was up 43% year on year. We're going to get into an in-depth look at the actual earnings, but you can already see members up 34%, products up the same amount. But one thing that really stood out was financial services. This sector is growing at an astronomical rate, up 106% from the same quarter last year, and their largest income stream, which is the lending, is also up 30%. We also like to point out to investors that we also get to see efficiencies on their margin, net income up 8 percentage points. And we can see initially after releasing the earnings, the share price was in fact up. We see members continuing to move into the company, and we're also going to get into their expectations for the year, which they have in fact raised. But we have analysts in 2 different camps for this company. We have one that sit alongside the likes of Bank of America, who believe this company is right now intrinsically overvalued. They see this in the $15 region. They believe it will underperform the market. And then you have others that do sit alongside Needham, where in fact they've been increasing their price target. They've seen a very strong quarter, and they believe $25 is where the company should be today. Now, we also have to remind you what SoFi are trying to do. They want to be the one-stop shop for any type of financial services needs. And that extends right across from loans, whether it's personal, student, or home, as well as credit cards, investing, and many different others. They just want this loop to be a place where consumers can have all of their financial services needs met. And it's also something that people are buying into. As we can see now, the growth of members has been increasing over the last few years at a rate of 51% year on year. Just look at last year, it was at 34% in terms of an increase. It's not expected to slow down in just this quarter, as we highlighted, equal of 24 at 34%. Number of products growth also astronomically high, 53% year on year, and actually an increase when 2024 we got 32%. In this latest quarter, it does sit at 34, and the growth extends to pretty much every single other metric. If we look at their revenue, for example, we can see it's up 44% from the same quarter last year. And if you just look at the previous years, it could be a case where actually we're going to see SoFi increase their revenue rather than see it slow down. We're noticing their margins, where it was EBITDA 26% in 2024, increase to 29%. Remember, this is a criteria of high quality company, not just revenue growth, but also in terms of their margin. And we also noticed their bottom line net income turning positive in 2024. Not only that expected in 2025, but we're also anticipating the net income margin to move to the double digit 11% like we have seen this quarter. And if you remember, when we took a look at this company over the last year, where they're moving towards capital light fee-based revenue, and actually that is something that we have seen increase over the last few years. 37% in 2024, much lower in 2021, and in the most recent quarter, 44%. That is what we have seen as well, growing at a very fast rate, where margins likewise are improving every single year. And that's backed up by looking at the EBITDA, 9% in 2022, 26% last year, and now sitting at 29%. And we can see here again growth on every single metric, EPS continuing to be positive, tangible book value increasing, expected to be growth quite significantly above 2024, and the return on capital employed moving in the right direction. So everything looking good so far with SoFi overall. And the financial service segment, as we highlighted earlier, it's up 2 times, and what's equally as impressive is margins continue to climb, 52% this quarter, same one last year, 31%. So we're seeing improvements, not just in terms of the revenue, the EPS, but also the revenue mix. They're increasing it towards those that do produce the higher margins. And we can see here the other element, lending, which whilst is up, not as impressive as what we got to saw from the previous income stream, 32%. Margins have started to decrease, makes sense why they are trying to move towards the financial service segment. And finally, from their investor deck, we get to see their guidance increase. This is becoming very repetitive. We're seeing this every single quarter. They're blowing out consistently, continually increasing guidance. Now, 2024, revenue expected 35%. They actually said they expect this to drop to 24, 27 in the previous guidance. Well, now they're bumping that up to 30%. Yes, a decrease from 2024, nonetheless, still very strong. They reported EBITDA margin 26% in 2024, expected increase to 27% this year. They've bumped that up now to 28%. The same story to be said on the bottom line margin, 9%. They thought it'd stay the same in 2025. No, an increase of 11%. And they're also expecting EPS, in fact, now to more than double to 31 cents, when initially it was expected 27-28 region. So lots to be impressed about by this company, but we have seen why they have been hammered today. And in terms of where institutions see this company with their 38% ownership, they've sold 1.1 billion worth in the last year. They bought nearly 50% more at 1.5 billion, but we've seen them ramp that up in quarter 2. Lot more buying than selling, 72 versus 17. Worth highlighting though, previous quarter they did sell more. Overall though, institutions clearly net buyers. And for consistency, whilst we like to highlight what super investors are doing, there's only one that actually holds SoFi within their portfolio. It is Samantha, as we can see here from Patient Capital Management, holding over $2 billion. And whilst they do hold SoFi, we can see the position 2.11%. In Q1, they actually reduced that position by 17%. Will be interesting in Q2 when it releases to see what they have done, as ultimately they're the only super investor that's holds SoFi within their overall portfolio. Now, Q2 was very strong. We've already ran through the expectations moving forward. What we would say is now over the last 5 quarters, this is a company that continues to outperform every single one. Very impressive. Well done to the management. And based on 2026 EPS, the forward P does lower to below 45. Some investors may believe that is warranted given the growth. Others may say still too costly. And in terms of the valuation grading, they do get a B-. Now the sector, no surprises, sits a lot lower. So you are paying a massive premium, 621. But actually, when you incorporate growth in the PG, the price to earnings growth, it comes to a 1, which is below the sector median, meaning you're actually getting a 21% discount. Surprising, but it does show you there is a lot of growth baked into these numbers, and that ultimately when you include that, it could be potentially undervalued. Not something we can say that holds true when we look at the S&P. This is the PG ratio right across the board. Many of them are sitting in red. Ultimately, towards zero makes the company more attractive. As we just highlighted, SoFi sitting at 1, and the growth itself sitting at an A+, year on year 30%. Well, as we've highlighted, they actually project this now to be higher on both accounts, well above the sector. And interesting to see EBITDA growth, probably no surprises, well above at 45% than the sector's 12%. And EPS anticipated to grow 79% year on year. We get here, in fact, the sector significantly below at 10.4. And profitability, whilst they do get a D-, they have started to turn positive. It was, in fact, the 7th quarter now. Gross profit margin, 83%, well above the sector at 60%. A huge improvement to their own 5-year at 79%. That is, again, efficiencies noted. Bottom line, 19%. Below the sector at 23%, but this has been improving every single quarter, not just every year. And we notice over the last 5 years, they were actually losing money, something we have highlighted. Now, it's not updated yet, but the cash from operations from the previous quarter was a negative 1.8 billion, improvement to their previous 5-year average of negative 4. But as we can see, sector isn't burning through cash. 160 million. We do anticipate cash from operations to turn positive very soon. So just one quick reminder, we get a buy from Seeking Alpha with a double hold from Wall Street and Quant, B- on valuation, A+ on growth, with a D- on profitability. Now, always good to compare the company against others in the sector. Here we have some well-known in the consumer finance space, and if we just look at the last year, we can see SoFi the best performing, up 46%. Now, others still have been positive, but not to that degree. And actually quite interesting to note, when we've looked at other sectors yesterday, notably healthcare and big pharma, we actually saw every single company punished, hammered down a lot. If we extend to the last year, they're up 185%, making them one of the best. We get here UPST, one that's piped them to the number 1 space, up 208. And if we zoom out to the last 3 years, again, very close, but SoFi in second place at 228. Just worth highlighting, though, that past performance is never an indicator of the future. And if we do look at it against the S&P and even the QQQ, year to date, massive outperformance, up 36%. S&P up 8, QQQ up 11. The same holds true, no surprises, massive outperformance, up 206%. S&P up 17, QQ up 25. Likewise, over the last few years, continuation of the outperformance, 227 versus 54 and 84. Now, we'll also just highlight some of the underlying metrics where the free cash flow for the large part has been negative, expected to turn positive. Sales growth probably does make you consider whether or not this company's growth story is slowing down. Not at the moment, though. Projected 2025 looking very good around the 30% region, but we can see from the highs of 2021 at 73%, it is in fact decreasing. Sales, we will come on to this in a little bit, but looking very strong. Worth highlighting, as they have just done today, they are diluting your position as a shareholder. Question is, if they can continue the outperformance against the S&P, you probably wouldn't be worried. ROE looking good as it has turned positive, and now definitely expected to see that in 2025. And net debt to EBITDA signaling the number of years it would take them to pay off all of their debt net of cash on hand. Ideally below 3, we see it at 2.27 on a trailing 12 month, expected to go lower to 1.8. Always something just to consider, and as we said, highlights balance sheet strength. Now, if we do have a quick look at their income statement, as always, first thing we want to gather is their revenue and the direction, and we can see it's increased quite rapidly from 2017's 507 million to 2.6 billion in 2024. Question is, very important one as well, does the bottom line net income reflect that movement? And the answer is no. They've been loss-making for a significant period, although already highlighted, turned positive in 2024, and as we got from the slide deck, expected to increase in 2025. In fact, most recent annual accounts 500 million, trailing 12 month 562. So expectation is there. They should be increasing their net income year after year. And the other thing is a quick health check, total cash versus total debt. Now a little bit inconsistent, nonetheless has increased from 326 million to now at 2.1 billion, but as always, one number in pure isolation gives nothing away, so we do a quick comparison against total debt numerically and directionally. Very surprising because we don't typically see this. Total debt has actually decreased over the period, 6.6 billion, now sitting at 4. We did see the net debt to EBITDA was below 3, but always something to compare, but cash and total debt aren't massively dissimilar. Overall, does look okay. And just before we get to the valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away. You can also grab a copy of severely undervalued stocks for the month of July. Lots of information for each one, the upside that Wall Street themselves see over the next year, and make sure you're signed up because we are dropping August's copy in 2 days. And on top of that, you can grab a recently released spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then jump into our valuation where we get to just under $19, and we'll just flag how we got to this value. We have the growth rate of 14%. Bear in mind, we have low, medium, and high, 12, 14, 16. Numbers are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's SoFi or any others. But based on 14% and the discount rate, we get the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to $19, indicating 10% downside. Now you can sit there and say these numbers are way too conservative. As always, when you grab a copy, you can put the numbers that you do believe, but full transparency, at 12%, $16.50, downside of 24, and for those that are a lot more optimistic, at 16%, $21.51, 5% upside. Now the reverse DCF highlighting that 15.7% is already baked into the numbers, and you could see that as very low, then ultimately you believe this company is undervalued. If you see this number as a little bit too high, then overvaluation. As always, whilst we do like to take through the middle rate of 14%, you can clearly see this means right now the company is trading at a bit of a premium. But as we'll highlight, if you do believe the growth rate is reasonable, then a buy with 10% MOS at $17, at 20% at $15, and at 25 $14. Now, Wall Street themselves also see this as trading at a premium. On average, they see a $19 price target into next year, downside of 10%. But as always, give us your thoughts where you see SoFi in terms of a buy, hold, or avoid. And we can also use the 16% growth rate that does give this 21.51 mark in terms of an MOS. At 5% is pretty much around where we see this. So ultimately, you do need to see a lot of growth over the longer term to sustain at least some kind of margin of safety. But the other exercise we have done as well for those that believe SoFi could one day, whether in the short or medium term, take over PayPal in terms of market cap, will bring SoFi's price to $57, indicating 172% upside. Just a fun exercise, but as always, give us your thoughts on SoFi, the earnings, the issues that have hit the share price, and don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, and as always, have a great day. We'll see you all on the next one.